14. That's the percentage. 14%. That's the portion of outstanding COMEX silver futures contracts currently backed by physical metal sitting in registered vaults. 760 million ounces obligated on paper. 107 million ounces available for delivery. Not total vault holdings, not eligible inventory. Registered, the metal contractually earmarked to fulfill delivery obligations. That means for every single ounce of real silver available for delivery, there are 7.1 ounces promised on paper. And if you think that ratio is normal, if you think the world's primary silver futures exchange routinely operates with 86% of its obligations, completely uncovered by physical supply, I need you to understand what that number looked like 3 years ago. It was 47%. 3 years before that, 62%. The coverage ratio hasn't been declining. It's been collapsing. Systematically, quietly. While every mainstream financial outlet obsesses over spot price movements and ignores the one metric that determines whether this market actually functions. Because here's what no one is reporting. In the last 90 days alone, 14.7 million ounces have drained from COMEX registered vaults. Not eligible, registered. The metal that backs contractual delivery obligations. That's a rate of 163,000 ounces per trading day, leaving the vault system. At that rate, registered inventory hits zero in 131 trading days. Not years, not decades, trading days. And while that drain is accelerating, open interest in silver futures has increased by 22% in the same period. More promises being written, less metal to honor them. The gap is widening at a pace that has only occurred 3 times in the modern history of commodity exchanges. Everything I'm about to show you comes from COMEX daily vault stock reports, CFTC commitments of traders data, CME group delivery notices, and historical exchange records from the London Bullion Market Association, NYMEX, and the LME. Not conjecture, not projections, not speculation. Documented inventory data you can verify on the CME group website before this video ends. By the end of this video, you'll understand exactly what the 14% coverage ratio means mechanically. You'll see the 3 previous times in history a major commodity exchange hit coverage ratios this low. You'll learn what happened in each case, to the exchange, to the price, and to the institutions on the wrong side of the paper. And most importantly, you'll understand the specific threshold below which delivery defaults become mathematically unavoidable. Because the coverage ratio doesn't decline in a straight line. It follows a pattern that accelerates at a specific inflection point. And that inflection point is closer than any headline has told you. The market cipher framework tracks a specific pattern I call the coverage ratio collapse sequence. It identifies the precise mechanics by which a commodity exchange transitions from functioning normally to facing systemic delivery failure. It happens in 4 stages. Stage 1, the confidence phase. Coverage ratios above 40%. The exchange functions normally. Deliveries are processed without delay. The vast majority of contracts are settled in cash, rolled forward, closed out. No one asks whether the metal actually exists because enough of it does. Paper and physical are interchangeable in the minds of market participants. Premiums stay flat. Lease rates stay low. The system works. Nobody questions it. Nobody needs to. Stage 2, the erosion phase. Coverage ratios fall between 20% and 40%. Sophisticated participants begin noticing the decline. Industrial consumers start securing physical supply outside the exchange system. Premiums for immediate delivery begin widening. Lease rates creep higher. Smart money starts taking delivery instead of rolling contracts forward. This accelerates the drain. Each delivery reduces the coverage ratio further, which motivates more participants to take delivery, which reduces the ratio further. The feedback loop has started, but it's still quiet, still invisible to most market participants. Stage 3, the awareness phase. Coverage ratios fall below 20%. This is where silver is right now at 14%. The decline becomes visible to the broader market. Delivery delays begin appearing. Premiums for physical metals start disconnecting from futures prices. Market participants begin questioning whether the exchange can actually honor its obligations. Standing for delivery becomes a strategic decision rather than a logistical one. Every contract that stands for delivery is now a stress test on the system, and the system is beginning to fail the test. Stage 4, the default phase. Coverage ratios fall below 10%. The exchange faces a binary choice: default on delivery obligations, or change the rules to prevent delivery. Settle contracts in cash at prices that don't reflect physical reality. Impose position limits that didn't exist the day before. Restrict the right to stand for delivery. Change contract specifications. Whatever it takes to prevent the moment when someone demands metal that does not exist. This is where London was in 1968. This is where NYMEX was in 2001. This is where the LME was in 2022. Let me show you exactly what happened each time, because the sequence is nearly identical. Event 1, the London Gold Pool, 1961 to 1968. 8 Western central banks formed a consortium to maintain the gold price at $35 per ounce. They committed physical gold reserves from their own vaults to meet market demand. For 7 years, it worked. Demand was met. The price held. Confidence was maintained. Then demand began exceeding supply. The coverage ratio, the amount of physical gold available relative to outstanding obligations, declined from over 60% to below 15%. In November 1967, the drain accelerated. 800 metric tons of physical gold left the pool in a single month. Not paper, metal. On March 15, 1968, the pool collapsed. The London gold market was shut down for 2 weeks. When it reopened, gold traded freely for the first time in decades. Within 12 years, gold went from $35 to $850 per ounce, a 2,328% increase. The coverage ratio told you the pool would fail long before the headlines did. The closure told you the price was about to be liberated. Every year of price suppression became compressed fuel for the rally that followed. Verdict: coverage ratio collapse preceded complete market failure. Price discovery was suspended. When it resumed, the suppressed price was released violently upward. The metal was gone. The obligations remained. The price adjusted. Event 2. COMEX Palladium. 1999 to 2001. Russia supplied over 60% of the world's palladium. Russian government shipments became erratic in late 1999, then stopped entirely. COMEX palladium inventory declined from 120,000 ounces to below 30,000 ounces. The coverage ratio against open interest fell below 12%. Delivery delays stretched from days to weeks. Premiums for physical palladium over futures prices exceeded $100 per ounce. Lease rates spiked above 75% annualized. The COMEX imposed delivery restrictions. Ford Motor Company, desperate for palladium for catalytic converters, did something remarkable. They signed a $1 billion forward purchase agreement directly with Russian suppliers, bypassing the exchange entirely, because the exchange couldn't deliver the metal. Palladium rose from $200 to $100, a 450% increase. The exchange didn't formally default. It did something more revealing. It became irrelevant. Physical buyers stopped trusting the exchange to deliver and secured supply through direct bilateral agreements. The paper market lost its authority over price discovery. The physical market took over. Verdict: coverage ratio collapse didn't cause a formal default. It caused something worse. It caused the exchange to lose credibility as a delivery mechanism. Price discovery moved off exchange. The metal went where the metal was needed. The paper became just paper. Prices quintupled. Event 3. LME nickel. March 2022. The London Metal Exchange maintained that its nickel contract was physically deliverable. But when Tsingshan Holding Group's 150,000 metric ton short position was squeezed, the LME's registered nickel inventory was a fraction of what would be needed to settle outstanding obligations. Coverage ratio against open interest fell below 8%. Rather than allow delivery failure to expose the gap between promises and metal, the LME halted trading for an entire week. They canceled $3.9 billion in completed, legally executed trades, changed margin rules retroactively, allowed Tsingshan to negotiate directly with its creditor banks rather than face market settlement. The LME chose rule changes over delivery default. They chose institutional protection over market integrity. Nickel had hit $101,365 per metric ton before the halt. After reopening, it eventually settled between $25,000 and $30,000, still 2.5 times pre-crisis levels. The LME is now facing multiple lawsuits totaling over $15 billion from participants whose completed trades were erased. Their reputation has never recovered. Trading volumes have permanently migrated to competing exchanges. Verdict: coverage ratio collapse forced the exchange to choose between default and destroying its own rulebook. They chose the rulebook. Market integrity was sacrificed to protect the institution at the center of the crisis. Prices still settled dramatically higher. The exchange still hasn't recovered its credibility. Some damage doesn't reverse. 3 events, 3 exchanges, 3 coverage ratio collapses below 15%. The same pattern every single time. The exchange does not formally default. That's not how this works. Instead, it changes the rules. It halts trading, it cancels trades, it restricts delivery, it settles obligations in cash. It does whatever is necessary to avoid the moment when a contract holder demands metal that does not exist in the vault. But the price still goes up, every time, without exception. Because rule changes can delay price discovery. They can create confusion. They can generate fear. But they cannot create physical metal. They cannot fill a vault with an announcement. The pattern is absolute. Coverage ratios below 15% have never been resolved by increased supply. They have always been resolved by dramatically higher prices, exchange intervention, or both. So the critical question is no longer theoretical. It's arithmetic. COMEX silver registered inventory, 107 million ounces. Outstanding futures obligations, convertible to ounces, 760 million. Coverage ratio, 14.1%. Drain rate over the last 90 days, 163,000 registered ounces per trading day. At the current drain rate, the ratio hits 10%, the default phase threshold, in approximately 60 trading days. That's not next year. That's 12 weeks from right now. Now let me layer in the data that makes this even more severe. Global silver mine production, 820 million ounces annually, flat for 5 consecutive years. No major new discoveries in the development pipeline. Average ore grades declining 2% to 3% per year across every major producing region. New mine development from discovery to first pour requires 10 to 15 years. There is no supply cavalry coming. Industrial demand, 700 million ounces annually and accelerating. Solar photovoltaic manufacturing alone consumed 161 million ounces in 2024. Projected 185 million ounces in 2025. Electric vehicle electrical systems, 5G infrastructure build-out, semiconductor manufacturing, medical antimicrobial applications. Each of these sectors is growing. None of them have a substitute for silver. Annual structural deficit, 198 million ounces. The 5th consecutive year, cumulative deficit since 2021, exceeding 800 million ounces. That cumulative deficit has to come from somewhere. And it has. It's come from vault inventories. COMEX registered silver has declined from 150 million ounces to 107 million ounces. LBMA reported vault holdings have declined by over 200 million ounces in 3 years. ETF holdings have been systematically drained as custodians redirect metal to industrial buyers willing to pay premiums. The financial holders are not. Every ounce leaving these vaults is an ounce that was backing a paper obligation. The paper stays, the metal leaves, the coverage ratio compresses. And here's the detail that separates silver from every other commodity in this analysis. Unlike gold, which sits in central bank vaults and jewelry boxes doing nothing for decades, silver is consumed. Industrially, permanently. It's soldered into solar panels. It's embedded in circuit boards. It's bonded into surgical instruments. It's layered onto window coatings. It doesn't come back. It's gone. Every ounce of industrial silver consumed is permanently removed from the supply available to back paper obligations. The denominator of the coverage ratio isn't just declining. It's being physically, chemically, irreversibly destroyed. The coverage ratio is 14% and falling. The drain rate is accelerating. The structural deficit is widening. The consumed silver is not recoverable. There is no supply response within any viable timeline. New mines take 10 to 15 years. Recycling yields approximately 150 million ounces annually and cannot scale meaningfully because the economics of extracting milligrams of silver from discarded electronics are prohibitive at current prices. No substitute exists for silver's electrical conductivity in solar cells, its reflectivity in concentrated solar mirrors, its antibacterial properties in medical wound care. This is not 1980, where two brothers cornered the market with leveraged paper positions and manufactured artificial scarcity. This is 700 million ounces of annual industrial demand from the fastest growing technology sectors on Earth, competing for 820 million ounces of mine supply, while 760 million ounces of paper promises sit on top of 107 million ounces of actual metal. The demand is real. The deficit is structural. The drain is measurable. The math doesn't work. And unlike financial abstractions, math doesn't negotiate. Now I know what you're thinking. Most futures contracts are settled in cash. Nobody actually takes delivery of 5,000-ounce bars. The coverage ratio has always been below 100%. That's how commodity futures work. The paper market has always been larger than the physical supply underneath it. It's fractional reserve by design, and it's functioned this way for decades without a delivery crisis. And you're right, it has worked. It works beautifully when coverage ratios are above 40%, when every participant trusts that if they wanted delivery, they could get it. The critical word is trust. The system doesn't run on metal. It runs on the confidence that the metal is available, not the actual exercise of taking it. The promise of deliverability is sufficient as long as the promise is credible. But confidence has a threshold. And every historical example I just showed you demonstrates that threshold sits somewhere between 10% and 20%. When coverage drops below 20%, behavior changes. Industrial users stop rolling contracts and start standing for delivery. Fund managers begin demanding physical allocation instead of paper exposure. Sovereign buyers accelerate direct purchases from miners, bypassing exchanges entirely. Each of these decisions drains inventory further, which pushes the ratio lower, which motivates more delivery requests, which drains inventory further. This is not theoretical. It is happening right now. India imported 27% more physical silver in the first quarter of 2025 than the same period last year. Chinese solar manufacturers have signed forward purchase agreements for physical silver extending through 2027, locking up supply years in advance. Central banks and emerging markets have begun adding silver to monetary reserves for the first time in decades. The demand for physical metal is accelerating at the exact moment the coverage ratio is approaching the failure threshold. This is not coincidence, it's causation. They're taking delivery because the ratio is low. The ratio is getting lower because they're taking delivery. The spiral has started. And spirals don't reverse because someone writes a reassuring headline. So what does this mean for you, practically, specifically, starting right now? First, understand that the coverage ratio is the single most important metric in the silver market today. Not spot price, not RSI, not moving averages, not what your favorite analyst thinks about the daily candle. The ratio between paper obligations and physical metal determines whether this market functions or fractures. Watch it daily. COMEX publishes vault stock reports every business day. 107 million ounces registered as of this recording. If that number drops below 90 million, stage 4 of the coverage ratio collapse sequence has begun. That is your signal. Second, recognize that physical silver and paper silver are diverging, and they will continue to diverge. The futures price and the physical price are separating. Premiums on coins, bars, and rounds are widening. Delivery times from major dealers are extending. When you buy a futures contract, you own a promise. When you hold physical metal, you own the resolution of that promise. In a system with 14% coverage, promises are abundant. Metal is not. Understand which one you're holding. Third, if you hold futures positions and intend to take delivery, consider standing for delivery earlier in the cycle rather than later. When the coverage ratio hits 10%, the exchange will change the rules. Position limits, delivery restrictions, cash settlement mandates, liquidation-only orders. The time to exercise your contractual right to metal is while the exchange can still honor it, not after they've rewritten the contract to ensure they don't have to. Fourth, watch for the rule changes. When the CME begins raising margin requirements specifically on silver, when they impose position limits that didn't exist the week before, when they announce any modification to the delivery process or contract specifications, that is not bearish. That is confirmation that the coverage ratio collapse sequence is advancing exactly as the pattern predicts. Exchanges do not change rules for markets that are functioning normally. Rule changes are the exchange telling you, in regulatory language, that the system is under stress. Every rule change in London in 1968, on NYMEX in 2001, and on the LME in 2022 preceded higher prices. Not lower, higher. Fifth, track LBMA vault reports, Shanghai Futures Exchange inventory data, and Indian import statistics alongside COMEX numbers. Silver is a global market. Metal leaving London vaults for Shanghai refineries or Mumbai warehouses is metal that will never return to back Western paper obligations. The global drain matters as much as the COMEX drain, possibly more, because once that metal crosses into industrial supply chains in Asia, it's not coming back. It's being consumed permanently. Subscribe to the Market Cipher and turn on notifications. The next video will map the exact flow of physical silver out of COMEX and LBMA vaults, where it's going, who's buying it, what they're using it for, and how many trading days of registered inventory remain before the default phase threshold is breached. I'll show you the specific institutions increasing their delivery demands, the specific industrial consumers securing forward supply at any cost, and the specific rule changes the CME is most likely to implement based on the precedent from the 3 historical events I just walked you through. Here's what the data shows. 760 million ounces obligated on paper, 107 million ounces in registered vaults, a 14% coverage ratio draining at 163,000 ounces per trading day, 3 historical precedents where coverage ratios fell below 15% on major commodity exchanges. All 3 resulted in exchange intervention and dramatically higher prices. None, not one, resulted in increased supply resolving the crisis. Silver's structural deficit is 198 million ounces annually, widening, and unfixable within any reasonable timeline. The metal is being consumed faster than it's being mined, and the consumed metal is gone forever. The exchange is not going to default. That's not how this story ends. What they are going to do is change the rules. They'll settle in cash, they'll restrict delivery, they'll impose limits, they'll protect the institutions that sold 760 million ounces of promises backed by 107 million ounces of metal. And when they do, the gap between paper silver and physical silver will become the most important spread in commodity markets. They can change the rules of delivery, they cannot print silver. The information is here, the data is public, the vault reports are published daily. The pattern is documented across 3 exchanges, 3 commodities, and 5 decades of market history. The coverage ratio doesn't care about sentiment. It doesn't respond to CNBC segments. It doesn't adjust for optimism or pessimism. It responds to ounces. Ounces in, ounces out. And right now, more ounces are going out than coming in. every single day. Drop a comment below. Tell me what premiums you're seeing on physical silver in your area, what delivery times your dealer is quoting, whether your broker has changed margin requirements on silver futures this month. Every data point from every market participant in every region builds the picture. I read every single comment. The coverage ratio is 14% and falling. The historical threshold for exchange intervention is between 10% and 15%. Silver is not approaching that window. It is inside it right now. What happened in London in 1968, on NYMEX in 2001, and on the LME in 2022 is not a warning about what might happen to silver. It is a blueprint for what is happening to silver. Thanks for watching the Market Cipher. And remember, exchanges don't change the rules when the market is functioning normally. They change the rules when the math turns against the institutions the exchange was designed to protect. 14% coverage is the math turning. The rule changes are coming. The only question is whether you position yourself before they arrive or after. See you in the next one.